Hello, everyone, and welcome back to the J22 Report. I'm your host, Johnnie Market. You all know that drill. Smash that like button, subscribe if you haven't. Just a little disclaimer, nothing should be construed as financial investment advice. Just my opinions, thoughts on the markets below. Let's get into today's stuff. I haven't been able to really do a lot of videos like I used to. So I'm not going to go into too much of the economic data, just some of the stuff that I feel is relevant. I'll probably still go in the economic data, but not like I normally do. But one thing that really caught my eye was the retail sales. Retail sales declined 9% or zero point 0.9, however they say it. Uh, Retail sales, they fell in May. And you have to remember, this is the summer season. This is the summer traveling season. The vacation retail sales should be increasing, not declining. The decline should come in like January or February or March. Shouldn't be coming in May. So that's a very poor sign of the economy. And what's even worse, shows how bad is that the declines came in gas and auto purchases. Well, the thing is, if you don't have a job, you're not going to be driving to work. So, of course, gasoline purchases are coming down. It's not because, oil and gas prices are coming down. We're just producing so much oil and gas. The reality is people aren't using gas because they don't have a job and they can't drive to work, regardless of what the regardless of what the unemployment rate says. And auto purchases, if you don't have credit, you don't have a job, they verify your income to get that auto loan. You're not going to buy a car. Maybe you'll take, you can't take Uber, but you'll take the bus or you'll take public transit to where you need to go. You'll probably just walk to your local store. Maybe you'll take uh, I don't know, but maybe you'll take a bus, a train, maybe you'll ride a bike, dust off the old bike. But yeah, headline retail declined by 0.9%, surpassing economists' expectations of a 0.6% decline. So yeah, these are very bullish, bearish and worrisome things, declines in gas and auto purchases. And this is the other thing. I talked about the auto loans. No one else did, but you're starting to see it here. When you default on your auto loan, you're not going to be able to take out a new one. So people aren't going to be buying cars. And I covered how the auto loans are starting to ratchet up. Well, now it's starting to get into the headline data. What is it declining? The auto purchases. So there it is, 2% decline in sales, 3.5% per in autos, and look at this, 2.7% decline in building materials. Well, people can't afford homes, so they're going to stop building. And then what's going to happen is more layoffs, and inventory is going to explode to the point where prices are just going to come down drastically. Look at this, temporary drags. Yeah, right, my ass. So yeah, that's the thing. The sales. This shows how bad the economy is. According to GDP now, the Atlanta Fed, the actual GDP is supposed to be 3.5%, which shows. They're not going to crash. The market's not going to crash this year. I thought this may have been the year, but when I saw Warren Buffett was gonna, it was 3.5. Now it's 3.4. So we'll see how it goes. The Atlanta Fed, they're expecting a 3.4%. Look at this. Real residential fixed income growth decreased from 2.8% to 4.4. And that's the thing. The bond market is really going to hurt. And the bond market's in a new bear market. Not a new, it began in 2021. And a bond market's eventually going to lead to a bear market in stocks. So right now, the Fed, they're not doing recession, but this is another thing I found interesting. It's increasingly difficult to find a job in the US. That's because we're in a recession. Number of Americans receiving jobless benefits jumped, the highest level since November of 2021. Outside the 2020 crisis, is the highest in 7 years. And it's going to get worse. And not that, employers are getting super picky. So they're not going to hire anyone. This is what's going to happen. They're not going to hire anyone. And then when the economy starts growing, they're going to hire people at a very expensive rate, like they did in 2022. They should have been hiring people in 2020 when wages were depressed, but they didn't. And then in 2022, they grossly overpaid for labor. And it's because stupid people run our companies in America. And that's why. So they should have been hiring. You got to think opposite. If you want to do great, you got to think opposite. Just like buying stocks now is stupid. Basically, unless you're buying for long term, unless you're buying oil stocks, but not even that right now. I mean, if you're like, in my opinion, not investment advice. Gold's going much higher, so I mean, but it's not investable anymore. It is more of a trading asset now. Uh, but anyway, keep going. America's deepest inflation fears are starting to fade. And this is one thing I want to talk about. To me, this is more of a contrarian indicator because I think there's one more big wave of inflation. It's going to hurt the stock market this time. And what I think it will start with the tax cuts. I think the tax cuts, they're going to go, and these tax cuts are going to really ratchet up inflation. Might do one more upswing in the stock market. It's going to really ratchet up the gold market. And then after that, you're going to see really bad inflation. So here it is, University of Michigan Consumer Sentiment, inflation. So yeah, inflation, this is a contrarian indicator. So more about notice how they're not talking about bringing manufacturing back now that they're close. Coca-Cola closes U.S. factory, fires everyone, and more could follow shortly. So there it is. Coca-Cola is closing down another factory following high food prices, food shortage, and stubbornly. So there it is. Coca-Cola. And this is an American company, very and right now the housing market's sort of in a mist. You have to remember the housing market is sort of like the gold top, except for housing since '09 has been in a rip-roaring bull market. 2020, the end of that's probably the top. But since it's a long bull market, you have to remember the tops are long. And the top began around 2023 or 2024. And now what it's doing, it's trying to get all the suckers in, just like the stock market. But this is why you're not going to see persistent gains. So here it is, right here. Mortgage demand drops even as rates fall, the lowest since April 2021. Now, what I think will happen is a lot of people who have these 4% rates, when rates go low, more homes are going to come on the market, but less buyers. Yes, mortgage demand for home buyers fell 3%. Demand to refinance loan dropped 2%. So what I think is going to happen when the Fed lowers rates, more homes are going to just overwhelm the market, and that will be a real nominal decline in the housing market. Not a decline in real times, not a weak consumer sentiment is weighing hard on the housing market as potential home buyers pull back. So you're seeing a lot of problems, and certain areas are starting to break. Florida, Texas, the Sun Belt, Nashville, Denver, among others. It's going to go everywhere in the United States, so do not think for a second. So you have this. Look at this. Home sellers are sitting on nearly 700 billion worth of listings, an all-time high. All these listings, there's no buyers. Prices are going to fall through the roof. Look at this. There hasn't been this 2018. Yeah, there's no buyers. prices are going to fall through the roof. So, and one example of prices already beginning to falling. Look at this. More builders slash prices as home buyers are staying away from the market. This is 2 days ago. Home builder confidence sank to a 2-year low as buyers began to shun the market. Builders are lowering prices in an effort to bring them back. Right here, builders. And if the housing market crashes, this is going to be a good thing. Yes, there will be people who own homes that have home equity that will be hurt, but overall, this will be good for society as a whole, because the homeless problems and all those will decline. So, builder sentiment of the housing market fell significantly in June as buyers generally continue shy away from purchasing homes. Of course, it's not a high interest, it's high price environment. People remember '08 and they're not buying. So that's the thing. All those gains from 2020 on have to be undone if you want to get buyers back in the market. And remember when they talked about an AI boom? I said it was BS. I hope everyone listening to this channel says it's BS. A couple people unsubscribe, so they believe the hype. But yeah, it's here. The good thing about Trump being president is that this time around, unlike last, is the mainstream media is a little more honest about the economy now because they're trying to make Trump look bad. It was this bad before him, but they're more. Look at this. Republicans may need an AI boom to have any hope of paying for their big, beautiful bill. Well, I mean, I thought that if you were listening in 2023, all you heard about was an AI boom was coming. I thought it was a sure thing. Why do they may need an AI boom? They're acting like this is not a sure thing. It's not going to come. Well, an AI boom isn't coming. Yeah, there's ChatGPT and everything, but an AI boom, meaning lots of jobs, booming, increasing growth like the 2000 tech bubble, it's not happening. So, and they're telling says long way it could happen is an AI fueled boom. And look at this. Everywhere economists say there is one long shot way it could happen. AI fueled boom. Yeah, an AI boom is a long shot. I mean, it's a 1% or it's one out of a billion. It's like that movie Dumb and Dumber, 1 in a million. So you're telling me there's a chance. So there it is. I mean, and they're also being honest in a sense that not just that an AI boom's not going to happen, but that this tax cuts, it's going to be bad for the deficit. So there it is. One of the things I want to get into is S&P. And do you notice where we're at right now? This is the S&P 500. It's at 5,980. Has not broken that 6,000 high yet. I mean, it has gone above it. It may. I mean, I don't think it will. I don't know if it will break it or not. But you can tell it's sort of bumping up against it. And if you ask me, this is a suckers rally. They're trying to get in the last suckers. Now, it could go up, make new highs like 6,200 or 6,500, then begin. Or maybe this tax cut will bring more money into the markets. Like the first tax cuts he did, that brought money overseas into the US markets, but then it will crash. So, one of the other things we're going to go, this is the year of precious metals. And this is the one thing I always say. When you look at it, gold leads all major assets. Gold, then Bitcoin, then emerging markets, Swiss franc, energy, industrial US stocks, treasuries, WTI dollars negative. But yeah, so and they actually had something interesting in here. Silver is about 28.2% return. And then platinum is a 41%, which I always like platinum. I said it on this podcast before. I didn't say it regularly, so some might have missed it. But I liked it when it was 1,000. I was buying platinum, pure platinum jewelry from 700 to 1,000 uh, per se. I'm up on all those purchases now. I think platinum is going to go up more. I mean, it could. I'm not a buyer of. I'm not. I don't really think anything's investable right now, except for oil stocks, in my opinion. I could be wrong. Investable means you can take it, hold on to it. After the next couple upswings, you're going to be up for a long time. But anyway, I'm going to go into a couple of more articles I'm going to bring up because I just want to get rid of this stuff. These are all very interesting. And let's see. I just feel these are things I think everyone should be. I think I covered this. And let's see. Here it is. Americans have rarely been this pessimistic about the job market. And the share of employees with positive view fell 44% in May, lowest since 2006. So you look at this. This is all right here is where Americans are. 2016, lower than that. No one's really. And the thing is, when people get laid off, this is bad for the stock market, but they're not contributing to their 401ks anymore. That's less money going in their market. Companies aren't matching, so that's less money going in the market. A lot of them have matching policies, so that's more sellers and less buyers. So that's why, if you look at this, retail frenzy continues. So do you believe the retailers, or here it is, institutional investors continue to dump U.S. stocks? So here it is, institutional is dumping, retail is buying. There was one other thing I wanted to get into, is that a lot of foreigners are dumping. Do I have that? I'm looking at right now. Just gonna look at this real quick. But this is another reason, is it's not just, if you look at this Google, international buyers dropped 36%. This is 3 hours ago. Foreign buyers retreat. This is housing market. So you see this. Uh, so maybe there is, well, maybe there is, but there's a lot of them retreating from the housing market. And look at this, U.S. economic activity is deteriorating. U.S. economic index, 23 points, lowest in 9 months. So anyway, that's all I have. Hit that like button, subscribe. Just remember, not financial investment advice. Read more on disclaimers below. I'll see y'all next video.